Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Fanakil bin Wafaizi. So, in this video, I will explain that's how the fiscal policy and monetary policy can boost the aggregate demand or the output level in the economy during this economic recession, particularly during the MCO period. So, the threat of depression might come from the loss of productive capacity, business shutdown, and the mass unemployment. So, during the MCO period, many people have lost their jobs, and the statistic also shows that there is a rise in the employment level, which it shows that 5.3% in the level of unemployment during this May, and and the mass unemployment will interrupt and imbalance the aggregate demand, particularly the component of investment and consumption, which is the main driver for the aggregate demand or the aggregate expenditures. A central notion, the Keynesian of the equilibrium of output requires that the output level to be equal to the aggregate demand, and this equilibrium of output can be expressed in terms of Y equal to C plus I plus G. So, in the Keynesian model, the first assumption that is the economy is in the closed economy where there is no involved in the international trade. Y is the output level, and C plus I plus G is the component of aggregate demand, where C is the household consumption or the private consumption, and I is desired investment by the private firms, and G we can explain that in the government spending in this case. So in this economic recession, we can see that the level of consumption will fall. Because what? Because people have less income, and when people have less income, they will cut their spending or the consumption level in the economy. Why? Because people have lost their jobs, right? Business cannot maintain to pay their worker, and business also lack of capability to maintain the operation. Because what? The desired consumption has fallen in the economy. So the another reason why the aggregate demand is fall because the desired investment is less than the realized investment. So here is the desired investment, and this is realized investment. In the ISM model, an equivalent statement of equivalent condition is I plus G equal to S plus T. So I is investment, G government spending, S saving, T is tax. The Keynesian model consider a simplified case where the simple case of the equilibrium will be I equal to S. I is R, realized investment, and S is Y, income. So what is the relationship between income and saving? So when the income fall, people have less income, right? So when they have less income, they will have less saving. So there will be a less saving in the economy, right? So the amounts of goods and service that can be produced in the economy is depends on the demand of saving economy has in order to be translated into realized investment, right? So like I said before, the aggregate demand fall because the desired investment is less than realized investment. So the demand of saving in the economy is less because people have less income right now. So the realized investment is greater than the desired investment. So like I explained that the desired investment is less than realized investment. So it means that the firm is operating in excess capacity because they are not utilize the machinery or plant in the full capacity. So does it mean that it means that the firms will cut the workers, and they will cut the production levels. So in this case, if the central bank cut the interest rate, firms were not likely to invest at any level of interest rate because there is no use for firm to invest if they are operating in the excess capacity, right? and with the level of consumption has fallen down, it means that no one would buy or use their service in the economy. So there is no point for the firms to invest at any level of interest rate. If the firms are not very responsive to any change in interest rate, it means that the interest elasticity of investment function is low. So they are not very responsive, right? So if the interest elasticity of investment is low, it means that investment curve is steep. Investment curve is steep. So the IS curve will take after the slope of investment curve. So if the investment curve is steep, IS curve also relatively steep. So in this case, lowering the interest rate through the expansionary monetary policy, it would not be effective to increase the aggregate demand. So the author has suggested the expansionary fiscal policy by the increase in government spending, for instance, temporary extension and expansion of EIS benefit, employment insurance system, but through the government fundings. And the author also suggests the government to increase spending, like increase the amount of bantuan sehari hidup or the bantuan prihatin nasional. So we will explain that's how the fiscal policy can boost the aggregate demand with the given steeper IS curve by derive the ISLM model. So the increase in the government spending will shift the IS curve from the IS0, G0 to IS1, G1. So the horizontal shift from the A to A prime is actually change in G. 1/1 minus B is the size of policy action as well as the autonomous expenditure multiplier. So the initial equilibrium point is A, where the intersection at S0, IS0, G0 and the LM0 at intersect RO, output level YO. So as the output level increase, the interest rate must increase to keep the money market in the equilibrium. So the increase in the interest rate will cause the private investment to fall slightly to offset pensionary of government spending. So the decline in the investment caused the output level in the ISLM to fall short below the extensive of this A until A prime. So actually output level is supposed to increase until A0, but in this case there is a little crowding out effect, because when the government increase the spending, it will make the interest rate to rise. But in this case, the private investment is not very sensitive to any changes in interest rate. So the output level will fall shortly from A prime until to this equilibrium point at the output level Y1. Even the output level is fall due to the fall in the private investment, but it can increase much larger from Y0 to Y1. So it depends on the IS curve. It's whether it's steep or it's flat. When at the stage 1, the author also suggests that Bank Negara Malaysia to enhance the existing financial facilities under the BNM funds by increasing the special relief facilities for the SMEs, such as lowering the interest rate. Okay, the main objective is not to increase the output level, like has been explained before, that lowering interest rate will not affect the output level to increase much larger, right? So, but in this case, main objective to assist the SMEs so they will have access cash through the lower borrowing cost, right? And they will have sufficient liquidity to pay their workers. So the lowering interest rate in the short run is one of the monetary policy tools that central bank will use to increase the money supply in the economy. When the central bank increase the money supply, what's happened in the money market is the money supply in the money market will shift to the right from MS0 to MS1. So the money demand, the equilibrium money demand will be at A prime, right? But at the A prime, the money market is experience excess supplies of money. So what happened after that is the interest rate will fall from R1 to RO to the new equilibrium point at the money demand and money supply. We want to know what's happens to the ISLM model, right? So the equilibrium point A is actually correspond from the money market. So at the equilibrium point A, the LM naught and S naught is intersect with the steeper IS naught, right? So whereby the interest rate is at RO and output level is at Y naught. So after the increase in the money supply, the LM curve will shift from LM naught MS naught to LM1 MS1. So output level, if you can see here, is slightly increased from Y naught to Y1. So the new equilibrium point will be at B, where the interest rate is at the R1 and the output level is Y1. So with this steeper IS curve, the fall in interest rate will not affect the output level to increase so much. It can be concluded that the increase in money supply by lowering the interest rate will not affect the output level to increase much larger, but it will likely to sustain or maintain the output level at the normal level. Okay, and firms will have sufficient liquidity to pay their workers. Therefore, the negative spillover effects on other business along the supply chain can be avoided through the lower interest